What's going on, guys? It's John DeYong here, and today I want to talk to you about the cash rate. There's been a lot of hype in the media about the cash rate dropping to historical lows. But what does that actually mean, and how is it going to impact the property market? The cash rate influences other interest rates within the economy, affecting the behaviour of lenders and borrowers, economic activity, and ultimately the rate of inflation. The Reserve Bank of Australia, also known as the RBA, is Australia's central bank, and its primary job is to conduct the monetary policy and issue the nation's currency. Every month except January, the RBA board meets together and they look at the current economic activity, its environment, and the recent trends. And then they use that information to decide on the nation's best monetary policy. This includes setting that cash rate, which really is just the interest that banks charge each other on overnight loans. If you didn't know it already, banks actually lend each other money every single day, and they do this just to manage their daily cash needs. So if Bank A is short on cash, they can borrow the money from Bank B. And this is what we call a short-term loan, also known as an overnight loan. So this cash rate is really the interest rate that the banks charge each other to borrow for that short-term period or overnight period. The Reserve Bank of Australia is a body corporate that's wholly owned by the Commonwealth of Australia, and they work towards the best interest of the Australian economy, which, if you're a part of, you should smash that like button if you haven't already. In the last 5 months, from June to October 2019, we've had 3 cash rate drops of 0.25 basis points each. If you're not sure what a basis point is, it's just a point of a percentage. So from all the way back in August 2016, we've had a cash rate of 1.5%. And in the last 5 months, we've seen 3 drops at 0.25%, which totals 0.75% drop. So it's come from 1.5%, now it's down to 0.75%. This cash rate then gets passed on to the banks, who decide if they want to pass it down to their clients or not. They don't have to pass down the full 0.25%, they can decide to drop it by 0.1%, but then they're not being as competitive with other banks in the market. If the banks then decide to pass the rate down to their customers, they're actually going to decrease the amount of interest on all of their packages. And this includes loans and savings accounts. So basically, if you've got a loan with a bank, you're going to be charged less interest for borrowing that money. Or if you've got a savings account with a bank where you've got money stored and you're earning interest, you're actually going to be earning less interest because the interest rate is coming down. This encourages the population to spend more money. Rather than just having it there in a savings account earning less interest, they're going to go out and spend it. Additionally, it encourages people to borrow more money at that lower interest rate to buy assets, so they can go out and buy a new car or they can go out and buy a property. Ultimately, this just recycles more money back into the economy, and it's what we call stimulating the economy. We're basically encouraging the population to spend more money so that there's more money in the economy and it can grow. As with any business, the banks have overhead costs too. They've got to pay for offices and staff. So that's why the interest rate that they give you doesn't match the cash rate set by the RBA exactly. They actually put a bit of margin on top of the interest rate that they give you, and it's typically around 2%. Lower rates typically mean an increase in housing prices. There's been speculation that borrowing capacities, which is just the amount of money that you can borrow from a bank, has increased by 15% since that cash rate was at 1.5% and the borrowing criteria has loosened from APRA. This means that banks might give you up to 15% more to borrow than you previously could have, giving home buyers more money up their sleeve to spend. Generally, us Australians love the confidence boost of going out and borrowing as much as we possibly can, buying the biggest house we can afford and showing it off at the next barbecue, which then encourages the 3 people that we talk to at the barbecue to go out and do exactly the same thing. So they all go out and borrow as much as they possibly can, then they've got extra cash to spend and they're going to go and overpay for a property, and it just creates this spiral of demand and pricing for property. The reason for this rate cut in October has been addressed by our Governor of the RBA, Philip Lowe, on the 1st of October, where he says, "We are seeking to make more assured progress towards both full employment and the inflation target. We still expect to make progress on both fronts, but that progress is slower than we would like. Today's decision, together with our decision in June and July, which is when we got the 2 previous rate cuts, will assist on each of these fronts. In doing so, these decisions will promote the collective economic welfare of the Australian people, which we will need to remember is the ultimate goal of the monetary policy." The RBA is most likely just going to sit back now and analyse any of the new data that comes through from the lower cash rate. Although there has been speculation that there's going to be another rate cut in February 2020. What do you think? Is there going to be another rate cut? Let me know in the comment section below. So in recapping, when it comes to property, having that lower cash rate generally means that we're going to get a lower interest rate from our bank, meaning we're paying less interest on any mortgage or home loan that we've got with a bank. Additionally, banks can now assess your serviceability at this lower rate, which is basically just your ability to pay back your home loan repayments. At this lower assessment rate, banks may now be able to provide you a home loan approval that they couldn't have previously. In addition to these owner-occupiers now having more confidence to go out and buy their new family home, investors are in the same boat. They can actually borrow more money too. So that's when we get this sort of stampede at open homes where, 100 people are coming through the door, and these bidding frenzies at auctions where it just drives the prices of property straight up. As always, seek your own professional financial advice for your current situation. This video is just my opinion and interpretation on the cash rate. If you want more content like this, hit the subscribe button and the notification button so you don't miss a video. And until next time, happy house hunting.